this environment that we're in. We're going to get to our weekly wrap segment here momentarily, but first I want to start with our poll. We always have a poll running on our StockCharts TV live stream page right off of StockCharts.com, but also on social media. We send polls around regularly, and this week we asked, will the next 10% move in the S&P 500 be higher or lower? Let's keep it super simple. You have two choices. Where do we net out? 6 to 4, 60% to 40%, opting for lower over higher. I did not vote in this poll. If I did, I would have agreed with the majority in this case and agree that the next 10% move is going to be lower. That's a tough one, though. And it's hard to be, suggesting a 10% drop, given, number one, that we haven't had one year to date. Maybe that's what makes it easier, I guess. But other times when it felt like we were certainly at the precipice of a 10% move, we never got anywhere near that. Most we've had is 5 to 6% at the most. And we continue to go higher, right? Again, we have another week of making higher highs. It's interesting as we go into our wrap the week segment a little more deeply. I'm struck today. My conversation with Mark Chaikin yesterday was very constructive. He was super constructive on the market. He suggested a seasonal pullback made a ton of sense, which most of my guests did. And Wednesday with Sam Stovall was a really good discussion about August and how challenging that tends to be for stocks. But still, there are plenty of Augusts that turn out just fine, right? Remember, these are seasonal tendencies we're talking about, not seasonal facts about what August is going to look like. I'm interested recently today, I spent a lot of time earlier in my career working with Tom DeMark and people that use DeMark indicators, which actually just registered a major sell signal today, if I remember right, on how the count was going to play out. And that's based on basically the daily close versus the high and the low. There's a lot of details behind his indicator, but basically it's a measure of trend exhaustion and just triggered a sell signal today. So for what it's worth, we certainly have had negative breadth conditions. We now have some seasonal trends that are suggesting negativity. I think the Tom DeMark signal that we may be rolling over as well is setting up for next week to be potentially painful, but as long as the S&P keeps making higher highs, there's not much pain to be held unless you're short or in cash. And the S&P just closed, touched 44.40 earlier today, closed around 44.36. Now, there wasn't a huge up day relative to previous ones. And yesterday, you had a huge acceleration to the upside going into the close. Really didn't see that today. It was more range bound for the course of the day. Noticeably, the NASDAQ and the NASDAQ 100 both down today, 4.4 to 0.5%. Technology was one of the weaker parts of the market. Consumer discretionary was the weakest of the 11 sectors. And the VIX actually went back down. It's teasing 16 from above. Real story today, and we're going to hit just a quick recap before we get to the weekly trends and and how things have evolved. But 10-year yields testing 130 again. Now, these were in 111 a couple of days ago. So it's been a big bounce in rates, and that's why financial stocks are doing just fine today for sure. Is higher rates tend to be better for cyclicals, particularly financials. That really speaks to their business model. So bond prices, the TLT that we usually follow, down almost 2% today. The dollar index appreciating back up to 25, sort of a larger move than we usually see for the dollar, but still remaining below 25, which has been a ceiling of sorts in recent weeks and months. Gold really accelerating to the downside. Precious metals both feeling a good deal of pain today and selling off going into the close with the GLD below 165 here. Most of energy was, or most of the commodity complex was down today. Energy actually was up 1% looking at the energy sector. A lot of discussion about cryptocurrencies today, and Bitcoin up 5% today to finish the week relatively strong, touching the 43,000 level. And we talked about 42,000 being a key resistance level. We traded just above that in the last 24 hours. So I think going into the weekend, which tends to be a little lighter trading as you would expect, but going into the weekend, into next week, I think we'll be very keen to see if 42,000 holds. I think that is the first level. That's the resistance level that's been proven a number of times in recent months. I think eclipsing that, and today is not enough to say that level is broken. That's trading above it. Closing above it is one good thing. Remaining above there is going to be key. So we'll see how things play out through the weekend into next week. Let's look at our weekly wrap chart, or wrap the week chart, if you will. So these are color coded. I'll explain to you where we're at. The S&P 500 is here in black, which finished the week about 0.9% positive. So sort of a, not a huge follow through week, really signaling broad strength. Breadth overall readings are relatively weak relative to where they have certainly been in previous bull market cycles. And while this is not an accelerating market, It certainly still is an improving market. And as I've told people earlier, I was writing a note to my own subscribers earlier today, and I'm not struggling to find stocks making new swing highs today. For example, you have the broker dealer index making a new all-time high. So there's no shortage of stocks like Morgan Stanley in that sector or elsewhere in healthcare and tech and in many other sectors breaking to new highs. It's happening. But I'm also not struggling to find stocks that are breaking down and are feeling some pain on the downside, following through to the downside. So it's sort of a disagreeing market, if that makes sense. So what outperformed the S&P this week? Not much. Here in pink, we have the NASDAQ 100, which was literally just a rounding error, about 1%, we'll call it. For the week, 1.1% are small caps, which is up here at the top. It's not been often that the small cap index has outperformed the S&P, and that just came really on the strength today with financials and some of the cyclicals working. Everything else pretty much underperformed stocks this week, with emerging markets and the dollar both up about 0.6 to 0.7%. Down for the week, we had bond prices down 1% using the TLT, gold using the GLD down 3.1%, and the worst of the bunch, crude oil down 6.1%. This is using the USO, which is a good kind of short-term gauge. I'll use that for intraday movements. But anything longer than a week, I'd encourage you to use the crude oil future. That's a better measure. That's $WTIC on StockCharts.com. Let's add Bitcoin in the mix just so we can see where that was. And it was actually the worst going through yesterday through earlier in the week, and then just accelerated to the upside. You can see it pushing higher and actually winning the week here relative to the other asset classes, finishing up 1.5%. Most of that, if not all that, came today, really, with a big move to the upside and finishing strong. The last couple of days have certainly been pretty good for Bitcoin. It's an interesting chart because it's been so range bound between 30,000 and 42,000. We're testing the upper boundary of that, and I think that's a really key chart to watch. It's interesting to see how it trades over the weekend, because last weekend was a little more movement than normal. So let's pay attention to that for sure. Let's finish up the wrap of the week segment here, looking at the Mindful Investor Live chart list. If you're new to our show or new to my work, you can access this list from StockCharts.com at any point. Go to the member dashboard, click on articles. Actually, is the easier way to do that. It's at the top of the website. Up here where it says Stock Charts blog, go to my homepage, which is called the Mindful Investor, and you'll see a little button at the top that says Live Chart List, and we'll get you to this list of charts, which we'll review now together. We start off with the market trend model. We review this every Friday at the close, and that's when I update it. I try not to touch it or mess with it intra-week, but I focus and update all the readings as of Friday. No change in this model really for the last couple months, to be honest with you. The long-term model has been bullish since June of 2020. The short-term model has been bullish except for about 3 or 4 weeks over the last 8 months where it's flipped negative. But overall, the short-term trend has remained positive, and that makes sense given the trajectory that we've had. The medium-term model, though, turned negative for me in May. And the way I think about that, that's sort of my main risk-on or risk-off model. What I tend to think of it this: should I be leaning more thinking about return or thinking about risk, or potential return versus potential risk? And the sell signal that you got in May tells me to think more about potential downside. And it's been very helpful in terms of recognizing the weakness on charts like JP Morgan and others making lower highs, energy, a lot of the cyclicals that have rotated lower, airlines and others that, started to show signs of strength and all started to rotate lower. It's been great, very, very good for managing the downside risk there. The challenge, though, is obviously the market has continued to go higher, and I've described this market as what I call a stealth correction, where the indexes are going higher, but there are a lot of stocks that are not participating in that. So if your portfolio is comprised of the wrong names here, you probably have had a painful couple months as the S&Ps and NASDAQ has gone higher, but the stocks you're holding, particularly if it's leaning into the cyclicals, are struggling a great deal. Really, really close the last couple of weeks to turning positive. It has not turned positive yet, and I try not to overthink this model. This is just the thing that runs in the background. If it would turn bullish, then that tells me to be much less cautious and be thinking about upside potential. But the fact this remains bearish during a seasonally very weak part of the year, given the exhaustion indications I mentioned earlier and the breadth deterioration, I think it's overall, I'm leaning more negative than positive, which is tough when the S&P 500 chart looks like this. Now, I have to tell you, remember, I'm a big believer in trend following. I'm a big believer that there are 3 things you're trying to do. Number 1, identify trends. Number 2, follow those trends. And number 3, anticipate when those trends are over. So in terms of identifying trends, it is undeniable that the trend in stocks has been higher. And I would say based on the performance of the S&P around its 50-day moving average, until we violate that, even given a short-term pullback, I will remain pretty constructive overall in the market as a whole, because the 50-day has been support. That has been the level. At some point, the 50-day will not hold. If there's one thing I can guarantee, it is that we will not remain above the 50-day moving average forever. At some point, we have to break it. I'm amazed we have not broken it yet. I certainly have expected it before now. I will, believe it when I see it, which means until then, you have to assume that the 50-day moving average continues to indicate the strength in stocks. So following the trends, I've had no problem following the trends that we've mentioned, stocks breaking to new highs, stocks remaining in strong price and relative profiles, I think are good. The market itself, I think, still deserves the thumbs up vote as it continues to push to new highs. In terms of that third piece, which is anticipating when the trend may be exhausted, that's where the breadth deterioration comes into play. That's where the bearish momentum divergence, like we saw in July, comes into play. Overall, again, the trend is the trend, and previous momentum divergences, like we're seeing now, have led to a 4 to 5% pullback in the S&P. I think that's a reasonable expectation here. If you ask me to predict what is going to happen, and again, I don't know any more than anyone else does, but I think a base case, given the seasonal weakness, given the breadth deterioration, given everything that I mentioned, is the S&P goes down about 10%. That would take us to 40-50. That would shake out a lot of the overextended nature on a lot of the charts that I've seen. That will shake a lot of people out that have just been buying and enjoying this uptrend. I think from there, though, you can set the stage to accelerate and make new highs for the end of the year. That would be my base case. However, that is a total guess. I actually I put a video on my YouTube channel a couple weeks ago talking about what a correction could look like, and gave 4 different scenarios of what the market may do, and another one called a Choose Your Own Adventure, where you actually vote on which of the scenarios you think makes more sense. Check out my YouTube channel called Market Misbehavior if you want to see those scenarios. I'll talk about the one that I just mentioned among many, many others and what they might look like as they play out. In terms of market breadth, when I talk about breadth deterioration, 2 charts come to mind. This is one of them. This is the advanced decline line for the S&P 500, making higher highs and higher lows as the S&P makes new all-time highs. These are all the other advanced decline lines making lower highs. So the most recent up move, June into July, was not confirmed by any of these other breadth measures. That is pretty much what February of 2020 looked like. Now, the only difference we've had from now and then, from a technical perspective, is that the index is not broken down yet. That's what happened there. By now, in February 2020, you've rolled down to the downside. So again, I feel, as I have a number of times, we're setting up for a downturn. I've not seen the downturn yet, and again, I'm going to respect the trend. Continue to be happily holding names that are making higher highs and higher lows. In terms of new lows, you have a number. It's not many though. So if you look on the S&P 500, this week on average, you had about 50 to 70 names. That's about, what do you call that? 10 to 15% of the S&P making new 52-week highs on the average day, and only 3 stocks making a new 52-week low. That is very, very, very small. You still have a small handful of numbers on the New York Stock Exchange. Look at the new highs, new lows on the NASDAQ, by the way, which I'm not showing here. And you'll see that there are plenty of new lows. And there's a lot of stuff in the NASDAQ that is questionable, much more than in the S&P or on the NYSE, but worth noting that some of the higher beta, riskier stuff has certainly broken down. Last chart or two, and then we have to wrap it up here. Only 57% of the S&P members above their 50-day moving average. We'll see when that updates for Friday's close today, where that registers maybe above 60. I think that would be an interesting change, because the lack of stocks breaking back above their 50-day moving average has been an important piece. That it would have to be the cyclicals that would cause that to happen most likely. The bullish percent index, by the way, still remaining below 70, but really close to giving an all clear and getting back above that bullish line. That is what I will absolutely be looking for next week to see if that actually happens.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.